Great. So we'll get started here. Um, so welcome. Thank you for spending your afternoon, coming here this afternoon, spending your lunch maybe with us. My name is John Peterson. I'm the Executive Director of Coastal Housing Partnership, and we are happy to provide these webinar series for our member company employees. Today's topic is from renter to homeowner. So we'll talk about that process and some good steps if you are currently renting and interested in becoming a homeowner. This is a webinar, so you won't see yourselves and you won't be able to talk, but if you want to ask questions, we would welcome that and would love to respond to those. So please use the question and answer section. We won't be monitoring the chat section. You may not have access to that, but use the question and answer section, and we'll be posing those to Chris. We had another presenter who had to cancel for personal reasons, but in addition to the executive director, I'm also a licensed real estate agent, so I'll be providing some feedback, but most of our questions will be directed at Chris today. So, and then we'll be sending this out, the recording to you and everyone who signed up later on as well. So we look forward to having a good discussion, but we're going to share some conversation with you first. But feel free to provide those questions as we go along. So with that, I'd like to welcome our presenter, Chris Conlon with Movement Mortgage, and give him a chance to introduce himself a little bit.
Nice. Thanks, John. Hey, everybody. I'm Chris Conlon, like John said, with Movement Mortgage. I've been in the mortgage industry for the last 22 years, which I cannot believe. That means that I am getting older, which is, yeah, I've been in the mortgage business for a long time and seen a lot of different marketplaces. I have a lot of passion around what we do, especially in this context, going from renter to homeowner. That is usually my specialty in terms of the clients that I attract over this 22 years in the business. A lot of changes have happened significantly over the time. However, this is such a great time to be in the mortgage industry and really helping people out. So I've done kind of everything in the mortgage industry. I've been in executive management. I've been in origination. I do manage a branch now, which is great, and then also deal with new construction lending as well. So really a broad array of work in this industry, and like I said, a lot of passion. So thanks for having me, John. I really appreciate it.
Yeah, well, we're glad to have you and your expertise with us. So now is a great time for the mortgage industry. Is now a good time to be buying a home?
Yeah, it's a great question. So I get, and that's probably the biggest question that I get right this very second from most everyone. We have seen interest rates change in the last 2 years, significantly have risen as a change in just inflation, the job market, et cetera, et cetera. And that's still been the biggest topic. Is it still a great time to buy based upon interest rates and based upon home prices? And the answer to that question is it is so unique to every individual and family that's looking to buy. From a macro level, we look at affordability, we look at programs that are available. And yes, there are absolutely opportunities right this very second in this market. And it's really the broad strategy of what people look at. One of the things that we really talk about is not being so transactional. So the idea is really mortgage planning. So a lot of times our first-time home buyers are not buying the home that they're going to end in perpetuity. They will not be there forever. And a lot of times it will be a first home that gets them to their next home, and then we'll get them to their dream home eventually. And it's kind of that stair-stepping idea of getting from one home to another over time and really getting in that space. So is it right time now? It is super, super individual.
Yeah, well, I believe that. And I know we're all kind of curious about rates and stuff, but you talked a little bit about this, or at least one of the advantages with the stepping up to the home that you want to end up in or getting into that. But what are some of the other advantages to home ownership would you share with somebody who's considering it?
Of course. So when we think about on the investment side, and I'm going to talk to you about the real pros of home ownership, and this really is what I'm passionate about. So I will share with you a couple things, and I really want you just to kind of expand your thought process when you think about this. But buying a home is such a significant purchase. Obviously, it's the largest purchase typically for someone to go through. You do a few different things when you buy a home. From an investment standpoint, it is year over year, we do see equity gains typically in most housing markets. There's only been about 4 to 5 times over the last 40 years that we've seen an actual decline, and pretty small in terms of equity over time. So what that means is when you buy a home, the idea is that it does appreciate over time. Typically, we are seeing anywhere between 2 to 7% year over year gains. So if you do buy your home, I'm just going to give you for an example, if you bought your home for $600,000 today, and we received a 5% year over year equity gain, you're adding about $30,000 worth of equity year over year. There's not a whole lot of investments that have that proven strategy over time to increase 5% year over year while providing shelter for you and your family, to provide a place to make memories. And the other idea is you also have a 30-year fixed mortgage. And in my opinion, the 30-year fixed mortgage is the greatest invention of American history. It truly, truly is. And people say, how do you say that? We've got the Model T car, we've got the light bulb, we've got the In-N-Out cheeseburger, right? How is a 30-year fixed the greatest American invention of all time? Well, it will truly hedge against inflation. So the beauty of the 30-year fixed is when you put your loan together, that payment will stay in perpetuity until that loan is paid off. So if you have a 30-year fixed mortgage payment and you make all 30 payments, those payments will never change. Now, here's the best part. Typically, your income is going to increase. Your wage growth is going to increase. Every month you're making a payment, you're reducing the principal amount every single month. So as your equity rises, as your principal balance goes lower, you're gaining equity over time. Now, here's the best part. Interest rates are dynamic. They can change. They can go up. So you're protected if interest rates go up because you're in a 30-year fixed product. When rates come lower, guess what? You can also look at refinancing into a lower interest rate, which will in turn drop your payment lower. You're also gaining equity over time, and that's also, we have the capability of even tapping into that equity to get into the next home. So there's a lot of different ways that we can really structure, and this is why the mortgage planning is so, so important in the entire process. So I hope that answered that question.
Yeah, that's great. I just want to clarify one thing you said. I don't think it's 30 payments. Those
Sorry, 30 years. 30 years of payments. Yeah. 360 to
360.
be exact.
Great, great. And what about some of the other benefits that you might have from like a tax perspective or
Sure.
a year-to-year basis?
Yeah, so great question. So tax benefit, yes. Typically, when we look at our first-time home buyers and people that are renting, they don't have a significant amount of deductions for tax purposes. And this is something that you will definitely want to talk to your tax provider about. But there are ways that we can take the interest deduction and help them against the taxable income that you have year over year. So there is some real tax benefits when it comes to home ownership and the interest associated. Great
Great.
question.
So those are great reasons to get into ownership. So if I'm renting now, what would you say the first step is for looking to move to a homeowner?
Yeah, of course. And John, I do want to just take a real quick step backwards real
Yeah.
quick, and we won't pivot too much. But you just brought up rental. So if you are renting, you're a landlord, you're already paying a mortgage. It's just someone else's that you're paying, right? So we've heard that analogy before, but as inflation goes up, landlords are able to raise and increase rent. So when you do have a mortgage that's on a 30-year fixed product, you won't have an increase in those payments. You won't have a landlord that will say to you, hey, you know what, we need to increase your rent this year or this
Mm,
month, whatever it may be. And so you are protected with that as well. So that's another benefit from home ownership as well.
great.
The first step really is finding a mortgage lender that you can reach out to or feel comfortable with, and kind of start asking these questions. I do really feel like the internet is such a great source. I think social media has really stepped up in terms of education. There's a lot of places you can find mortgage tips and hacks and tricks on TikTok, on Instagram, Facebook, LinkedIn. There's a lot of different resources. However, I really do feel like they can be ultra confusing if you've never heard that before. And there's sometimes where it can be kind of misleading as well. So I would reach out to a local mortgage professional, someone in your town. I always think face to face is always a great meeting, or a Zoom call, or just a real introductory meeting, and ask them about, affordability, and kind of talk to them about your situation, and really just kind of start planning that piece now. Sometimes we have clients that will come in and we can spend a full hour and we can get really far into the mortgage process. And then sometimes there's clients that we have 15-minute chunk meetings where we just kind of really get to know each other and then build that over time. And this is really what I think is important, is that you take your time to really understand and provide clarity and transparency on both sides to really figure out what the end goal is.
So, great. I think I would agree. I think finding a lender is the most important first step. And I would remind all those on this webinar that through your Coastal Housing Partnership benefits, on our website, we have a list of our partners, all those lenders who are partners who not only are great options for lenders, but also offer discounts on their fees. So that is one good place to start. How else would I kind of select a mortgage lender? Do I just look at the rates they're offering, or what's the
Yeah.
best tactic for kind of choosing a lender?
Again, that's a great question. I would look at someone that is local. And when I say that, it's just each market is so unique. So the market here in Ventura versus Santa Barbara, Ventura County, Santa Barbara County, much different than LA County in those areas. So I do think local is really a good place to start. The other piece is really finding the best fit, really in that interview process, who you feel is a good fit. Again, I really feel like clarity and transparency is really so important in this large of a financial transaction. The other place, you can always look at Google reviews or look at the experience.com reviews. You can do a lot of kind of searching on the internet and find out about the people in your local market and what other clients are saying about them. I think that's really helpful, and you can kind of get a flavor of what you're looking at. A lot of times, us in the industry have really built our business upon the education piece. If that is your style and you like that, I'll give you, for example, I really love to explain a lot of different things. And I know there's a lot of lenders out in the marketplace that share that same passion that I have around explaining and really helping our clients understand what they're getting into, what that means, and that way there are no surprises. So I think that's going to be really important for you as well.
Great. And so I found a lender that I connect with. They've explained me things. What are they going to do for me? What are they going to give me at this point in my process of
Sure.
looking at home ownership?
Yeah, great. So typically what we do is once we've connected and we feel that it's a good fit, we like to get an application done. That is truly the most accurate. It creates a real baseline of what we can provide. Now, I will share with you, in this 22 years that I've been in this industry, John, we have seen so many different products come and go. You've heard me say 30-year fixed on multiple occasions. That is not the only program that we have. There are adjustable rate mortgages. There are government insured loans. There are down payment assistance programs. There are just a quite a huge array of different products and programs. And once we get the application, that's going to show us the real baseline of what we can help qualify for. And that really will give us, as the lender, a real roadmap to figure out what the best options are for our clients. And so once we get that application, typically, and I won't speak for everyone, but typically what we like to do, you're going to hear a lot of conversation around credit and running someone's credit. And the biggest thing that we get on our end is, well, I don't want to run my credit because I don't want to drop my score. I do want to give you guys, everyone, kind of an idea around this. We can perform what's called a soft pull. So when we pull a soft pull on the credit, it's not a hard inquiry, and it will give us kind of a peek at what the liabilities are that you have going out on a monthly basis. So when you think of liabilities, think of credit cards, think of student loans, think of any sort of installment debt like a car loan or car payment. Those would in theory come up on your soft pull, and that will help us calculate what we call, and again, I'm so sorry for all these mortgage terms, but your debt to income ratio. And that's how we really understand what we can qualify someone up to. So when we look at this, a soft pull is a really good idea, although to be extremely accurate, a hard pull on the credit report is going to be the most accurate. I'll give you, for example, sometimes we'll pull a soft credit and it won't capture all of the debt that may be coming out on the credit report. And then once we do a hard pull, if we don't see a liability that has shown up, we do have to calculate that into the debt to income ratio. And sometimes we're not as accurate as we could be. So once we do the hard pull, or once we do a credit check, we do look at asset statements. We do look at income statements. So think of paychecks. Depending on how you get paid, it's pretty easy. And then we also do look at your W-2s if you're a wage earner. And a lot of this you already have handy, or you can get from your employer. And then once we get that, then we really look at the full entire package and we figure out what we can qualify our clients up to, and we have that conversation.
Great, great. That's helpful. Now, um, would this process cost me any money? Am I gonna have to pay you for this? And then what do you give me after? Or be
Yeah.
more specific. Can you explain kind of what
Sure.
if I'm pre-approval or others? And
Yep.
let me just say real quick, just a reminder, we've had a few more people join. Please put your questions in the question and answer section. If there's any terms that we throw out that don't make sense, please put those in the question and answer, and we'll be happy to explain them or revisit them. So
Yeah.
sorry. So go ahead, Chris.
Yeah, thank you, John. And that's a great point. If I ever use, or we use, any sort of mortgage jargon, always ask. These are the great questions, and we will always go back and explain those. And sometimes we use a lot of acronyms in our business, just like you guys in your business have a lot of different kind of language associated. And again, if we ever trip anybody up, always happy to explain. But John, on your end, I will speak for myself, but I will speak for most all lenders. We do not charge anything for this kind of consultation. We are happy to do that, and this is really typically how we put everything together to be as accurate as we possibly can, to help someone understand what they can afford, and that's why it's so important. Once we figure out, and there's a couple of different ways that we can look at this, and I'll share with you how I like to perform things, but this is certainly not what everyone does. But once we have the consultation, once we get the application, and once we start getting the documentation and we put together everything, I particularly use what's called a total cost analysis. So typically what that will be is every sort of interest rate that you could qualify for, the products that you can qualify for, the costs associated. And what I like to do is put that all together so it's very easy to look at the different options that we have available. And then we kind of start to narrow it down and figure out what the best choice is. From there, once we qualify our clients, we perform what's called a pre-approval. So there are three different ways that we can look at this. Number one, there's a term that's been in the industry for a long time, and it's a pre-qualification. And all that really is, John, you could tell me your credit score of what you think it is. You could tell me what your income is based upon a year. You could tell me what your assets are verbally. And in theory, I could literally put on a piece of paper that you are pre-qualified up to a certain amount. And that's all we've done is just had a very loose verbal conversation, and that would be a pre-qualification letter. Typically, when that goes into an offer time, or if you are working with a real estate agent, they don't want just a pre-qualification because it doesn't really hold a whole lot of weight. It's just a verbal conversation. When we look at a pre-approval, that means that we've looked, myself, my assistant, my team, other lenders that you're working with have looked at your income documentation, that we have in fact pulled the credit score, and that we are putting out a pre-approval letter from our company or from ourselves to you as a home buyer that says that you are qualified, pre-approved up to a certain amount. That's kind of the ticket, the admission that you get to go to shop for homes. Once you get the pre-approval letter, that is your admission ticket to go kind of start shopping with your real estate agent. I particularly like to take it one step further and do what's called an underwriting pre-approval, meaning that we actually get everything together and we will send it to our underwriting team and actually have a stamp of approval from an underwriter on our file. And that means that we verified income, we've verified assets, we've verified credit scores, and all the things that go into the recipe for a really solid pre-approval. So that way, when you do start to go and shop, if you do find a home that you like to make an offer on, we are ready to go because we've already taken that initial big step.
Yeah, and I would just add a couple things from the real estate standpoint. That underwritten pre-qualification, it can be a little bit daunting in this communities but you're basically can be competing with an all cash offer because your loan is underwritten and ready to go. And I would say one thing I've seen as an agent working with clients is there's a little concern. Well, if I'm pre-approved for X amount, um, can I offer lower than that, or will the buyer or the seller just say, "Hey, we want as much as you can get"? And I would say, remind you that you're just making a stronger offer, even if you're offering below that. If the house costs less, you're making a wise decision. Just because you can be pre-approved for an amount doesn't mean you need to spend all that money.
Correct.
On a home. And it's not something that the sellers are looking at to say, well, can we get more for the home? It's really just strengthening your offer and saying that, yes, we're ready and we can afford this home at this price that we're offering. So, um, you shouldn't feel concerned. You should, get all the information as to what you can afford, and then your lender will really help you think through like your budget and what you should afford and what you should look at as far as homes to look at and to buy within your abilities. So those can be really helpful for you and obviously for making your offer and making your offer stronger on a home. So um, all right, so when you're doing those pre-approvals and you're meeting with folks and you're getting the application, um, would you say that people are usually need a lot of lead time and need to do a lot of work on their financial situation, or do you find that people are maybe ready sooner than they would think?
Yeah.
So maybe it's worth talking to you now, even if I don't think I can buy for several years.
Absolutely. Yes, I would tell you more often than not, clients come in and it's just really some misinformation. A lot of times we still have clients that think that you have to have 20% down, or that you have to have perfect credit to buy a home, or that your income has to be huge, or can you get a gift for part of the down payment, or what are the different programs and procedures that we can do. So once we kind of start navigating through that piece, and we really start talking about options and what's available to clients, that the everything gets expanded to where I have a lot of clients that say, I could be buying a home right this very second. I have some money saved up. I've got my credit score nice, or at least, in a workable scoring mechanism. I've got my assets and income. Yes, I could do that. And I'm also paying $2,500, $3,000 a month in rent. So yes, I am ready. And that goes through, once we do start doing the real pre-qualifications and really look at the mortgage planning. So I have a lot of times clients maybe have a car payment that is going to be ending pretty soon, or maybe they have some credit card debt that's giving them some payment. And as opposed to using all of their money for a down payment, sometimes we can pay off some of that debt and relieve them of some of that extra monthly payment that will help them qualify for more. So when we look at these and we really mortgage plan, yes, I have a lot of clients that are pleasantly surprised that say, you know what, now is the right time, or maybe in the next 6 months, or you know what, for sure in the next year, if we go according to plan, we can absolutely be in that time period.
So did I hear you correctly? You don't always need 20% down?
You do not always need 20% down. You can actually go, we have products that will literally 0% down, believe it or not.
And if I have a special situation, if I'm a veteran, or what are some other categories or groups of people that I might be a part of that would offer some of those different types of
Sure.
products to me?
Yep. So first-time home buyer is going to be huge. We have a lot of products for specifically designed for first-time home buyers. Those are the lower down payments. Those are also down payment assistance programs. There's a lot of different products from different agencies. You did bring up something with VA. It's such a near and dear special loan to me. We do a lot of VA financing. You can go 100% financing with your VA entitlement, and it's a great product. We are really looking to help our veterans get into homes, our active service members. We are really looking to get them into homes. So that's something that we can qualify for as well. There are government insured loans. You've probably heard of what's called FHA. It's not necessarily a first-time home buyer product. The advantages of FHA are you can put as little as 3.5% down. You can go higher on what's called the debt to income ratio spectrum, and it will also lower credit scores. There's some real acceptance in terms of what we can approve based upon a lower FICO score. Great products, and again, there are so many. That's why it's so important to get with somebody to explain that to you.
Well, it seems like an important reason to get together with the lender sooner than later. And so as we think about going from renter to home buyer, homeowner, so we've gone to our lender now, we've gotten our pre-approval or pre-qualification, or maybe my underwritten pre-qualification, and now I'm ready to meet with a realtor. I would say similar to what Chris said about finding a lender, your realtor is going to be a similar situation. You want to find somebody that you connect with, that you get along with and can communicate well with, because you'll be talking to them a lot. You really want to find somebody who has experience, particularly in your area, who understands your region and your specific area that you want to be looking to buy. I know it can be enticing, or you feel like you should go with a family member or relative who just got their real estate license to help them out. If you're going to do that, just make sure that you kind of talk to them and see what kind of support they have in how to understand it, because it is a very complex process, which is leads me to my next point, which is why it's so important to work with a real estate agent. As a buyer, particularly first-time home buyers, but even experienced buyers will tell you there are so many steps that go into the home buying um, process, that having somebody who's been through all those steps and can help guide you along those and help you through them, from making, looking at homes, deciding what are good options for you, sorting through all the listings that meet your qualifications, then making an offer, negotiating that offer, having an offer accepted, the inspections, and all of the parts that go with it. It's really important that you have a team to work with, and people that you are comfortable with sharing some pretty personal details, financially and family needs and otherwise, And that in that idea of a team, you know, so Chris, you've given me a pre-qualification. I go find a realtor, then do I never talk to you again, or
So
what does it look like?
this is the best part of my job. This is what I absolutely love, and this is truly my vocation when it comes to what we did, what I've chosen to do with my career. You are not even close to being done with me. This is the best part. We are going to have you and your lender will have a very close relationship, typically, depending on how long this transaction is going to be. And the idea is, I think you've heard me say this before, transactional versus relational. So the idea is for me and my team, this is not a transaction, this is a relationship. So the idea is we can help mortgage plan now, and this is going to the next home, the next refinance, the next one or two or three or four refinances before we get into the next home, so on and so forth. That's the idea. So during the transaction, and John, a transaction can literally go, I can close, and our fabulous lender partners out that you work with, we can close loans in as little as 9 days, which is wild.
Wow.
Majority of my closings right this very second. We will help 15 families this month, and my average close time is less than 14 days on all of
Wow.
our transactions. So the process can go really quick. Now, what you're not hearing though is you're hearing 9 days to 14 days. But what's so cool about that is there's about 6 months that we've been working with these families to get to this point. So it's not
Mm,
just 14 days right off the bat, it's all the pre work that we've done and really gotten them super comfortable. They understand the process. And so that way, when it comes time to make an offer, they're like, let's go. Let's do this let's write an offer at 10 days because we're going to perform because we've spent this time getting to
mm,
understand the process. Some transactions can go 30 days. Typically, in a normalized market, is about 30-ish days. There's even some instances where we go 45 or 60 days. So during that time, the name of that process is called while you're in escrow. So while we're in escrow, we'll be having touch points. Typically, you're going to talk to me. Sometimes you talk to me every other day. I usually try to talk to my clients at least once a week, but someone from my team is following up with you pretty much every couple of days, either with a phone call, a text message, some sort of an email with updates, and that communication piece we probably over communicate just because we really are empathetic to the fact that this is such a huge life moment that you're including us in, and we really want to be respectful of that and make sure that you're dialed in.
yeah, absolutely. And it is really important that you have a good team because you are going to be talking to them a lot. There's a lot of anxiety, sometimes for new buyers. And as you say, Chris, it's a huge transaction. There's been some significant changes in the real estate industry that I want to touch on and we want to cover. There was something called the NAR, the National Association of Realtors Settlement, um, that changed the way that realtors commission is structured and communicated about. So you may know uh, that realtors make a commission or a portion, their fee is a portion of the sales price the home you purchase. Um, this is something that they have tried to clarify through this discussion, which is that the commission has always been negotiable. But in the past, prior to August 17th of this year, the commission was negotiated between the seller and the seller's realtor. And the seller's agent would then offer a portion of that commission to the buyer's agent. They've now separated those two. So the seller still negotiates their commission with the selling agent, and the buyer, you potentially, negotiate your commission with your buyer's agent. And this is the case with all agents and with your coastal housing benefits. The discounts are still offered. The conversation is just a little bit different. So you will negotiate a percentage Oftentimes, but there are no set rules, oftentimes the commission was 5% and it was split 2.5% to the buyer's agent and 2.5% to the seller's agent. So in you may commonly run into a buyer's agent discussing a 2.5% commission with you. That is your responsibility as the buyer, which is just shifting it a little bit. However, what can be done in the negotiation and the realtor can do for you is ask the seller to pay that on your behalf or give it what's called a concession. Um, and so it's a really important conversation to have. Don't be afraid of having that conversation and discussing how that's going to work, because it's a new step in the process where you need to sign a buyer's agent agreement before you start looking at homes. Um, it's something that's been out there, but not as commonly used, and now it's required. And so I guess I'm curious, Chris, now this went into effect August 17th. What would you say the frequency you've seen or thoughts on that sellers are covering this cost for the buyer's agent or buyers having to pay that? And how are they handling that in your experience so far? I know it's a new thing,
Yeah.
but maybe you've seen
So
a few of those.
today is the 22nd of October. You said August 17th is the day that it went into effect. So essentially, we've seen about 2-ish months. We've closed between me and my team a little over 30 transactions since that, and every single transaction, the seller was paying the agent's compensation. So it was negotiated. So business as usual in that term.
Mhm.
So,
Yeah.
yeah,
So I think that's important to know as you walk into this. There's going to be new conversations, but in reality, we're seeing that it's continued kind of business as usual. So I think that's great. It will help you have a clear understanding of how everybody is paid and otherwise. But it also leads me to another point and reminder is it's really good to have an agent working for you as the buyer and not just going into an open house and having the selling agent offer to help you. Because what you really want is a team that you know, that you've met, and that you've gotten chosen. That'd be your agent, your lender, and there'll be other people in the process that those two will help you with. But coming with your own agent or selecting your own buyer's agent first, you'll discuss this commission piece, but also you'll have them on your team and really helping you with the negotiations, helping you understand, giving you perspective. If you work with the agent who's selling the home, then they would have to disclose something called a dual agency. And the biggest concern for me, for you as a buyer in that case, is that that dual agent can't provide the same level of advice and support. They have to be more neutral and transactional. Um, and so, as Chris was saying, you want to have more of a relational interaction with your agent and your lender. And so, it's really important to kind of get ahead of it, go out, identify your lender, have these conversations with them, then identify your real estate agent, and start working with them and looking with them on how to get to the next steps. Um, let's see. So, Chris, what else should we know as we're getting ready to consider transitioning from a renter to a homeowner? Are there other things we've missed or you want to discuss?
yeah. What we're also seeing, John, and I do want to make sure that we talk about this. A lot of times, there's different things that go into your house payment, right? A lot of times we have your property taxes that need to get paid through your home payment, your insurance, just like you carry car insurance, you're going to carry homeowners insurance. And then a lot of times we'll find HOAs that are actually attached to the product that someone's buying. So when we look at that payment, we really want to make sure that encapsulates everything that goes into it. And there's, again, a lot of different terms that we use in our industry, but you really want to look at that full monthly obligation, whether you pay your taxes with your payment or you pay them separately. whether you pay your insurance through your payment or pay that separately, you really want to make sure you understand what your true housing payment is going to be that captures everything, and
Mm.
really understanding your budget and understanding what can change and what can't change. A lot of times we see that, when someone has their property taxes and the values go up and we get reassessed, their payment could essentially change a bit based upon their property taxes. So again, you really want to have someone that's going to articulate that so there are no surprises down the road. A lot of times what we see is, clients will look at their budget and sometimes they can sacrifice and make some changes to afford a bit higher on the monthly payment on the home side. And that will afford them maybe a home that they weren't necessarily considering. Or maybe, like I said, restructuring debt to maybe we pay something off and come in with a little bit lower on the down payment. And that can get them into maybe a house that fits more of what their choice is. So again, just a lot of different ways that we can kind of structure this, and really getting to understand that with a mortgage professional is going to be so key. That's why that relationship is such an important one.
Yeah, yeah. I just want to remind our folks on the webinar, please put we'd love to answer your questions specifically. Please use the question and answer section. Be happy to jump in there and answer those for you. Chris, you mentioned something. Maybe you could talk a little bit more about what this means or what this looks like. What's the escrow?
Sure.
What is the escrow process?
Yeah, so it's a time frame. So when we go into contract and you write an offer, so let's just imagine that you've been working with your mortgage partner, your mortgage lender, you've identified your sales agent, your real estate agent, and you've made an offer on a home. And let's say the seller has accepted your offer and you are now in contract or in escrow. So that term means the day that we go into contract, we've opened up escrow. And like I said, those timeframes can range. Short time frame, longer time frame, but for this illustration, let's use 30 days. So if we went into contract today on the 22nd, we're going to have until the 21st of November to get everything completed in terms of our loan approval, solid, our appraisal. So I do really want you to, I'm going to veer off just one second, but I'm going to come back. There are truly two parts of your transaction. You have your borrower side, which is you, meaning that your credit scores, your income, your assets, you as the client, you as the borrower, and your ability to repay your monthly obligation. That's you. That's one part of the transaction. The other piece is your collateral, which means the home itself. We do an appraisal. So it is by an appraiser that works together with the company that you are working with, choosing for your lending side. And they will do an appraisal of the home to ensure that the value is there of what you're buying it for. So there are two parts. So we have to get everything done in terms of the loan approval and the appraisal completed in that 30-day time period. And there are milestones throughout that period of your escrow. So a lot of times, there's a high focus from everyone because they want to close in that time that everyone's agreed to. So that way your process is moving accordingly, week over week or day by day.
I have a great question here. What are the average lending rates these days, and how much do they typically vary across lenders?
Great question. So our mortgage rate, the national average as of today, is at 6.8% on a 30-year fixed product. Now, remember, kind of going back to the beginning of this webinar, there are so many different products, so rates can change from product to product. So an FHA, government insured loan, could in theory have a different interest rate of a VA loan for our veterans. It could have a different rate for what's called a conventional, which is your 30-year fixed, or it could change based upon what the investor is that we're looking at. So rates kind of vary depending on product. Now, from a competitive standpoint, from lender to lender, that can certainly range by each lender. Typically, we are all kind of going to the same pond with our fishing pole. So in theory, the same place where we go for interest rates, We are fishing in the same hole. However, each lender can vary a little bit. Sometimes it could be an eighth, sometimes it could be a 1/4% on the interest rate. Sometimes the disparity could be even larger. It just depends on each lender. So there could be kind of a broad difference between them. Rates change every single day and can also change multiple times during the day. So this is the biggest challenge in our industry is a rate that we can quote in the beginning of the day can change drastically up or down by the end of the business day. So rates can fluctuate. So that's why it's so important to have those conversations and really get some clear understanding of what those interest rates look like. I will share with you, that's a great question. What can change in those interest rates or vary? Hyper focused on an interest rate before you go into contract can tend to be really difficult because you're shopping different places based upon an interest rate. So I don't want our first time home buyers or our home buyers in general to be so hyper focused on the interest rate because again, those can change. Lead with who do you feel most comfortable with? Who do you feel is really giving you the clear answer and really the education piece and who you feel most comfortable with? And then really start leading in with the interest rates because it can change.
So should I not be out on the internet finding a super low internet mortgage rate and go with that? Or what if I like you, but your rates are a little higher today? Um, you know,
Sure.
what should I do?
Yeah, great question. If some of our clients are hyper focused on interest rates and that is the only thing that they are concerned about, then yes, and I will speak for most everyone in my industry. We will gladly say, you know what, if that is the most important thing to you, there are plenty of online lenders that do have lower interest rates than what you can find maybe in the local space. However, we all want to be very competitive. So I think that we are happy to look to see if there's something that we can accommodate on our end. But in the broad picture and the overarching picture of this, really figure out what is the most important. If there's a huge disparity, that's something that you definitely want to discuss. But when it comes to an actual transaction and all parties associated, just really understand the entire dynamic of your transaction as opposed to just the very specific interest rate. And remember, you can refinance as time goes on. That's always an option that we can certainly look at. So,
Right. The old adage, marry the house, date the rate, right?
yeah, this is very, very much true. Typically, what
Um,
happens when you look at an online lender, they don't have the overhead that maybe a traditional lender will have. Not that that's a bad thing. However, it's just a much different process. Typically, that's very transactional. I won't speak for everyone, but typically it's not always the best interest of the client. And to really have that symbiotic relationship with their client, it doesn't usually happen just because, again, it is more of a big box transactional approach as opposed to, being that relational and mortgage planning and taking on that client for life mentality.
yeah. We got a good question here on a different topic that we haven't covered, but it's certainly an important one. And so that's why I love your questions because they are what you want to know about and maybe things we haven't covered. Uh, so the question is, has it been difficult for people to find insurance coverage for
Mm.
properties in Santa Barbara County or Ventura? And when in the home shopping process should you or your agent try to find out if the property is insurable?
Nice. That's a brilliant question. I'm so glad it got brought up on this call. Insurance is, yes, that is a hot topic right this very second. With our natural disasters, with our fires, with just what's going on in general, insurance is, yes, a very hot topic. Uh, Always a great opportunity to reach out and incorporate an insurance professional as well in this. Typically, myself on the lending side, we work with our partners as well on the insurance side. We also have your agent will usually have an insurance network that they can also reach out to, and I think that is really smart to do is find out if the property is insurable. If it is, what does the premium look like? I will share with you very specifically on all of our transactions. We always reach out to the insurance agent to figure out what that insurance policy looks like to make sure that we can fit that into our debt to income ratio. What we were calculating insurance costs just a year ago or even 6 months ago can change. And they can widely change between insurance carriers as well. So the back to the rate question, more of an important question is it can change wildly between different insurance carriers. So that can actually make or break a transaction because sometimes if we have a higher uh, insurance cost, that can flip your debt to income ratio over the threshold, which would take a loan from being approved to not being approved. So great question.
Yeah, it's a really important topic, especially in California and in our counties here. So it's also another important reason to have a local lender, because they'll know the insurance agents who are underwriting in our community, and they can help you with that. So
Absolutely.
we're coming up on our time here, so I just want to thank all of our attendees, and please, we have a few more minutes if there's other questions. These have been great questions from you. But I appreciate your time today, and really want to thank you, Chris, for all your wisdom and sharing that with our group here.
My pleasure.
Those who signed up.
Yeah, this is my music, and you're allowing me to play it. So I really I have to say thank you to everybody. This is a true passion of mine, really helping people, and the education is so wonderful. And I will speak with, I know majority of your lenders that you partner with, and I really feel that we are all commonly, the common thread is, we really want to provide an excellent service and really just help and make sure that this is a very pleasurable experience. And
Yeah.
again, you're allowing us to be part of a moment in your life. And we, again, feel very empathetic and very appreciative for that. So thank you.
Um, Thanks, Chris. We got another question. So lenders often ask you to sign a commitment letter. What happens if you end up not using them? And I can also talk to the buyer's broker agreement
Yeah,
too.
absolutely. So we are not bound by the same sort of broker buyer agreement that you would find on the real estate side. So on the commitment letter, there's actually a term that we use on the commitment side. We will actually give you as the buyer a commitment letter, meaning that we want to lend to you and that our underwriters have underwritten your file, and we as a company are giving you a commitment to lend. If you wanted to shop around and use a different lender, you by every right have that opportunity to do that. And whoever you feel most comfortable with, there is no contractual signing on our end, and you are free to use whomever you'd like.
Yeah, and from the buyer's brokerage agreement, under the new rules, when you do sign that, I would, definitely encourage you to meet with the real estate agents. And if you don't connect with them, you don't drive with them right away, talk to somebody else before signing an agreement. It is a contractual agreement where if you sign a buyer's brokerage agreement with an agent and you try to buy a house with someone else, they could potentially ask for that commission and pursue that. So, this is where communication becomes important. I would say most agents are going to say, if you go back to them and say, you know what, I don't think this is working for us. I think we need to end this. And those agreements always have terms, a length of time where they will last and then they'll go away. But being able to talk to them and being clear in your communication, most folks are going to be happy to understand and want to work with you and want you to want to work with them. And so communicating and talking to them is going to be really important. But before you sign anything in a big purchase like this, it's really important that you understand it and think through that process before you sign anything. Because there can be implications, but also, again, with communication, you can typically move forward with those. So, Well, thank you all again for your time and appreciate your patience and attendance. And hope that you have a great rest of your day. And feel free to stop by, visit the Coastal Housing website to look for our list of partner lenders and realtors. And good luck to you all.
Yeah.
Thank you,
Thank you, John.
Chris.
You're welcome. Thanks, everybody. Thanks, John.